Item 2. Management's discussion and analysis of financial condition and results of operations. Components of revenue and costs and expenses. Our revenue consisted of consumables sold in the U.S. and internationally associated with our Assisi Red products, capital and consumables sold in the U.S. and internationally associated with our PulseVet Red platform, consumables sold in the U.S. and internationally associated with our TR Forma Red platform, subscriptions and services sold in the U.S. associated with our TR View Red products, capital and service agreements sold in the U.S. and internationally associated with our Vet Guardian Red products, consumables sold in the U.S. and internationally associated with our Vetigel Red products, contract manufacturing of Cell Guardian, a non-animal health product, and contract manufacturing and engineering services and consumables and capital sold in the U.S. Cost of revenue consisted primarily of the cost of raw materials, labor, and overhead used in the assembly of PulseVet Red capital and consumables, TR Forma capital and consumables, Assisi Red consumables, TR View capital and consumables, Vet Guardian capital and services, Vetigel consumables sourced under our supply arrangement with Cressalon, Inc., and labor cost associated with contract manufacturing and engineering services. We expense all inventory obsolescence provisions related to normal manufacturing changes as cost of revenue. During the first quarter of 2025, the company determined that a triggering event occurred, which required interim testing for impairment in accordance with ASC 350. Intangibles, Goodwill, and Other, ASC 350. The triggering event was related to the company's market capitalized value, which is a function of its stock price, which had reduced significantly subsequent to the delisting of the company's common shares from NYSE American during the 3 months ended March 31, 2025. We elected to perform a quantitative analysis as part of our interim goodwill impairment test. Our analysis of the PulseVet reporting unit indicated that its carrying amount, including goodwill, exceeded its fair value by approximately 163%. Our analysis of the Assisi reporting unit indicated that its carrying amount, including goodwill, exceeded its fair value by approximately 128%. As part of the company's quantitative analysis, we updated our implied fair value calculations to more closely align with our reduced market capitalization as of March 31, 2025. As a result, a non-cash goodwill impairment charge of $45,556 was recorded for the 3 months ended March 31, 2025. Given that no goodwill remained on our consolidated balance sheets after March 31, 2025, there were no further impairment considerations for the 3 months ended March 31, 2026. In connection with our interim impairment analysis during the first quarter of 2025, the company also evaluated its amortizable intangible assets for recoverability in accordance with ASC 360, Property, Plant, and Equipment, ASC 360. It was determined that the carrying values of certain intangible assets exceeded their fair values, which were impacted by the same factors noted in the goodwill impairment analysis. As a result, the company recognized $8,296 in non-cash impairment charges related to these amortizable intangible assets. During the 3 months ended March 31, 2026, no impairment indicators were identified, which would require a recoverability assessment of intangible assets under ASC 360. Additionally, as part of the interim impairment analysis, the company evaluated its property and equipment for recoverability under ASC 360. Based on this assessment, it was determined that certain property and equipment assets were not fully recoverable due to the same triggering event described above. As a result, the company recognized a non-cash impairment charge of $1,981 related to property and equipment during the 3 months ended March 31, 2025. During the 3 months ended March 31, 2026, no impairment indicators were identified requiring a recoverability assessment of property and equipment under ASC 360. Diagnostic-based TR-FUAR capital is placed in fixed assets once purchased or manufactured, where they remain undepreciated until they are placed with our customers under the agreement that they will repeatedly purchase consumables or services which are utilized within. Each instance of this placed capital represents an asset that we own. An estimate is made of the anticipated future revenue over its respective life, which is 10 years. If the payback period of the initial investment in the asset is less than the 10-year life of the asset, we conclude that the assets have been properly recorded and no write-down is necessary. We rely on various data points and assumptions, including, but not limited to, the expected volume of consumables which will be sold, anticipated growth rates, and anticipated placements. Realization of the anticipated revenue is dependent on the current assumptions and forecasted models. As of March 31st, 2026, the carrying value of our diagnostic instruments was $9,402. Significant assumptions included in the realization model are the rate of placement and expected utilization over the life of the instrument. A 25% reduction in the estimated revenues associated with annual placements of instruments would increase the payback period from 3.64 years to 5.04 years as of March 31st, 2026. The nature of our therapeutic device business segment gives rise to variable consideration, including discounts and applicator (TROD) returns for refurbishment. Credits are issued for unused shocks on returned TRODs, which can be used toward the purchase of replacement TRODs. When revenue is recognized, a simultaneous adjustment for returns is estimated, reducing revenue. Estimated return credits are presented as a reduction to gross sales, with the corresponding reserve presented as customer contract liabilities. The number of TRODs returned by year is tracked against the number of TRODs sold in that same year, creating a current experience rate. It is assumed that the ultimate return rate for the TRODs is 98%. For annual calculations, it is assumed that the expected returns in the current year for each layer increase to the experience rate of the year immediately preceding it. Once the 98% is reached, the layer is removed from the calculation. The annual incremental change in expected returns is multiplied by an average return credit amount, generating the current liability due to customers. Revenue for the 3 months ended March 31st, 2026 was $8,799 compared to $6,500 for the 3 months ended March 31st, 2025, an increase of $2,299 or 35%. The increase in revenue for the 3 months ended March 31st, 2026 was primarily due to contract manufacturing and engineering revenue recognized during the current period. Growth in TRFU-AR products, including the impact of launching new assays since the end of the comparative period. Growth in consumables sales in our existing PulseVet resin products. Contract manufacturing of Cell Guardian, which the company began in the current period. Growth in our existing Assisi assay products, and growth in our existing Vetigel resin products. Cost of revenue for the 3 months ended March 31st, 2026 was $3,315 compared to $2,093 for the 3 months ended March 31st, 2025, an increase of $1,222 or 58%. The increase in cost of revenue for the 3 months ended March 31st, 2026 was primarily driven by increased manufacturing expense resulting from higher unit sales, as well as increased salaries and wages associated with our manufacturing and engineering operations. Gross profit margin for the 3 months ended March 31st, 2026 was 62%, compared to 68% for the 3 months ended March 31st, 2025. The decrease in gross profit margin percentage for the 3 months ended March 31st, 2026 was primarily due to the impact of the change in product mix associated with our unit sales. General and administrative expense for the 3 months ended March 31st, 2026 was $5,413 compared to $6,262 for the 3 months ended March 31st, 2025, a decrease of $849 or 14%. The decrease in general and administrative expense for the 3 months ended March 31st, 2026 was primarily driven by lower wages and related benefits, lower general office expenses including those associated with our corporate office move in the prior year, which did not recur, and lower amortization expense. Research and development expense for the 3 months ended March 31st, 2026 was $1,154, compared to $1,853 for the 3 months ended March 31st, 2025, a decrease of $699 or 38%. The decrease in research and development expense for the 3 months ended March 31st, 2026 was primarily driven by lower wages and related benefits and lower external consulting and contracted development expenses following the successful launch of our new TRU Forma Regisilts and Vet Guardian Plus TM during the second half of 2025. Selling and marketing expense for the 3 months ended March 31st, 2026 was $3,817, compared to $5,007 for the 3 months ended March 31st, 2025, a decrease of $1,190 or 24%. The decrease in selling and marketing expenses for the 3 months ended March 31st, 2026 was primarily driven by lower wages and related benefits and a decrease in discretionary marketing spend. There was no impairment expense recorded for the 3 months ended March 31st, 2026. Impairment expense for the 3 months ended March 31st, 2025 was $55,833. The impairment expense for the 3 months ended March 31st, 2025 was due to impairment charges recognized as a result of a significant decline in the company's market capitalization following the delisting of its common shares from New York City American. The impairment charges consisted of $45,556 related to goodwill, $8,296 related to amortizable intangible assets, and $1,981 related to property and equipment. Net loss for the 3 months ended March 31st, 2026 was $4,534, compared to a net loss of $63,809 for the 3 months ended March 31st, 2025, a decrease of $59,275 or 93%. Net cash used in operating activities for the 3 months ended March 31st, 2026 was $5,257 compared to $6,648 for the 3 months ended March 31st, 2025, a decrease in cash used of $1,391 or 21%. The decrease in cash used in operating activities primarily resulted from the decrease in operating expenses noted above, excluding the impact of non-cash charges, including impairment expense. These decreases were partially offset by an increase in our trade receivables balances as of March 31st, 2026. Net cash provided by investing activities for the 3 months ended March 31st, 2026 was $5,622 compared to $8,406 for the 3 months ended March 31st, 2025, a decrease in cash provided of $2,784 or 33%. The decrease in cash provided by investing activities primarily resulted from lower securities matured in the current period and increased intangible investment, partially offset by decreased property and equipment capital expenditures. As of March 31st, 2026, the company had working capital, defined as current assets minus current liabilities, of $51,471. As of March 31st, 2026, we had deferred tax assets for net operating loss carryforwards for U.S. federal income tax purposes of $22,154 and non-capital loss carryforwards for Canada of $9,644, which will begin to expire in fiscal year 2035. We have evaluated the factors bearing upon the realizability of our deferred tax assets, which are comprised principally of net operating loss carryforwards and non-capital loss carryforwards. In 2021, we concluded that, due to the limitations under Section 382 Our U.S. federal income tax net operating loss carryforwards, as well as R&D credit carryforwards for the periods prior to February 11, 2021 have been limited to zero. We therefore have derecognized $3,814 of this asset, reducing the carryforward of these amounts to $18,340.